Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing how the US dollar Swiss franc has sunk to multi-year lows. On this 1-hour chart of the pair, we can see that on the 2nd of November, the pair had rallied to a high of 0.9207 before moving lower and where the market became extremely volatile on the 4th of November. The pair failed to re-establish itself at the previous high of just 2 days earlier. The size of the bars which have been highlighted can only mean that the extra volume and volatility had crept in, and all of these moves can be associated with the lead-up to and just after the US presidential election. On Friday the 6th of November, the pair had moved over 200 pips lower to find support at 0.8982, a multi-year low, before recovering to the key level of 0.900. In fact, we would need to go back to April 2014, which was the last time the pair had been so low, and much of this can be attributed to the strength of the Swiss franc, which is bought as a safe haven asset by investors around the world who see value in the Swiss franc economy overall. Although the chart is a monthly one, the huge swing in price range over 3,000 pips in August 2014 worried institutional investors and traders, and that, coupled with the Swiss National Bank's abandonment of its cap on the euro of 1.2 francs, which in January 2015 saw the euro-Swiss franc pair collapse to 0.8052 before recovering ground eventually to 1.04. Many traders were ruined by the unexpected move, and firms including Forex broker Alpari went broke. The Swiss National Bank has publicly stated on many occasions that it would defend the Swiss franc against strengthening with other currencies, especially the euro and the United States dollar, because a strong Swiss franc means that exports become extremely expensive and makes the country less competitive, and that is bad news for Swiss economy. They either intervene to sell their currency or threaten to do so, and that, coupled with the huge swings in price action which we have just shown you, just means one thing. Traders are extremely cautious about trading the franc, which is prone to spikes and sharp moves caused by the Swiss National Bank intervening in the money markets. That, however, has not stopped the Swiss franc from being bought during this extremely volatile time, which has largely been brought on by the COVID-19 pandemic. Economies such as the United States and Europe have been badly affected, and of course the current theme around the United States presidential election, which has been the impetus for the push below the 0.900 for the US dollar Swiss franc pair. This is certainly one pair to trade with tight stops, and where the bias to the downside remains for the foreseeable future. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.